today we're going to talk a little bit about the nature of financial markets and those entities that operate in financial markets that we refer to as financial institutions. This will be discussed in some detail in Chapter 2 of our textbook, which no doubt everybody is feverishly reading now. So we'll see if we can come up with a couple of summary ideas, really, that you'll find in the chapter. You're not going to get nearly enough information out of what we're going to do here on the PowerPoint slides or the audio file to avoid reading the book, so don't imagine that's going to be the case. You're going to need to read it, and with any luck at all, you'll remember some parts of it. And especially for people who have not taken any other kind of course that deals with financial markets and financial institutions, what are those, what kinds are there, so forth. You're going to get a lot of information out of Chapter 2, which will be helpful to you in the future, even if you never do anything further in finance beyond college. At least you'll understand a little bit about the world that, sad to say, far too many people have no knowledge of whatsoever. Here's what we're trying to learn on slide 2-2. We want to understand how it is, why it is, that financial markets are critically important for economic prosperity and social well-being. We'll talk about that a bit. We want to identify what are the major financial markets that we need to be aware of that form the idea of exchanges and finances, financial instruments principally. What markets are those? We want to understand a little bit about the role of what are called financial intermediaries. What does that mean as a term? We're going to give a first blush definition and look at something that's referred to over and over again in finance, the idea of the cost of capital, which is a very vexing idea when you first come to it, and then later on it's still vexing. And then after you study finance, it's vexing still. And finally one comes to a settled position on it and is just thoroughly vexed. So it has so many different nuances to it that's very hard to get the idea across to first-time students. We'll do our best. And we're going to encounter Mr. Cost of Capital again later on in the course in the theory of finance, and then if you go on and take financial management, which is BUS 3830, which is the second course in this series of finance courses here at our college, we'll encounter a lot more about the cost of capital in an applied sense, where it actually makes a whole lot more sense in an applied sense actually than in a strictly theoretical sense. And then we want to understand a little bit about the linkages and connections between how you go about maximizing shareholders' wealth and this idea of the cost of capital. Okay, so it turns out those have some interplay. Well, here's my whirlwind overview and summary of Chapter 2, and this may be fairly dry and witless. My interlocutor here may or may not come up with a brilliant question. It's hard to say because this stuff is so read and forget kind of stuff, but here we go. This is not exactly read and forget, so this requires a little bit of thinking. Most people don't get this right away, and some people never get it. A lot of our politicians never got it. But the ultimate source of capital, read that as money, to finance real assets that businesses buy or develop themselves, they don't buy them, is the savings of households. Now, when you just put that up on a slide like it is on 2-3, if you're just saying immediately, oh, well, of course, that's true, then you're mind-bogglingly intelligent. Most people look at that and say, well, what in the world does the savings of households have to do with businesses buying capital, plant and equipment? Where do you fall on that spectrum, Jake? Is that a brilliant statement or a fairly opaque statement right now?
Well, I've had a little more time to think about it. We talked about it over the summer, on foundations.
We did indeed.
Every person is a part of a household, whether it's just them or them and a group of other people. We all belong to a household. And if no one saves anything, there's not going to be anything to borrow.
That's exactly right. Now, what makes it seem like that's not the case is the existence of money. To make this the easiest as possible to understand, let's put ourselves in a world for a minute of an agrarian economy that doesn't use money. We haven't figured out yet money. We haven't developed any money. So how do we exchange with each other? Well, we just barter. We just trade cows for trucks and the like. So anything that, if we don't produce it and consume it ourselves, if we exchange at all, it's barter, what you'd call trading, if you like. Economists call that bartering. All right, so let's imagine that we live in a society that's somewhat agrarian, and we barter with each other. Now, if we produce, to make the example as concrete as possible, if we produce a field of corn, what happens if we consume all the corn?
Don't have any left.
Next year, we don't have any left. We haven't saved any seed corn. Nobody can plant any corn. So here's all these farmers standing around their faces hanging out. If we did not save some of our corn as seed corn, we're not going to be able to continue our business. That's clear. It's very clear when you make it that simple, isn't it? And when you extend that simple analogy to a broader context and think about, anybody taking this course should be able to think about this, because they should have had foundations of economics already, if not even principles of microeconomics already. Think about or macroeconomics, I should say, because that's where you mostly encounter. Think of the circular flow model of income, expenditures, and output. If all of this year's production of goods and services is literally consumed, used up as it were, what is left for businesses to use to put plant and equipment in place? And the answer is nothing. All right, so that's why this statement on slide 2-3 is quite foundational and fundamental to finance, because it is just the case that if a society's members, whether we call them households or individuals or not, if they do not save, then the business sector will not be able to borrow. If it is the case of, remember what were the two sources of finance? Equity or debt. So if the households don't save, if somebody doesn't save, certainly businesses can't borrow to put capital in place, nor can they entice somebody into ownership in the form of equity either. There isn't anything. There isn't anything. See, it's money itself that makes it seem like businesses could borrow, because they just borrow money. As people lose sight of the connection between real stuff and saving when they're in the presence of money. And I will assert without fear of contradiction, and willing to debate anybody on national television about it, that is precisely the problem that we face in the United States today. It is precisely the problem that Greece and Spain and Ireland and the other pigs have already set their foot on the path of, the notion that you can eat your seed corn and plant it too. That is precisely what's going on today. The notion that here in the United States we can consume, and we do not have to save. Somehow we can have our cake and eat it too, to use a phrase that everybody's heard before and maybe didn't understand. It always confused me. Well, wait a minute, if I ate my cake, didn't I have it? Yes, but that's not what it means. It should be, you can't eat your cake and hold it too, is what it should say. That's exactly it. And so this is what we're getting at here. By definition, saving is the opposite of consumption. In economics, we make that very clear. If you have a good or service If you consume it, you have, by definition, not saved it, and vice versa. If you save it, you can't exactly save the service, but you can save real assets. Then if you save it, you can't consume it. If households don't save, no capital is available for investment in real assets. Now here we're using the word capital. You could substitute money in there. If households don't save any money, then no money is available for investments in real assets. Except that's not strictly speaking true, as we also learn in Foundations of Economics, because of an entity called the Fed, they can invent some new money. But that's a lie, isn't it? And you begin to see why it's a lie. When you throw yourself back into the world of corn and seed corn, and now you plunk money in there. Just because you create some new money doesn't mean there's any more corn, does there? And so things become a little clearer when you begin to think in terms of real stuff and get the money out of the way. Household savings, of course, flow through financial markets to reach businesses. Well, what does that mean? Well, it simply means that here we are, we're the households, we're out here working and buying stuff and consuming and perhaps saving. Well, but what do we do with our savings? Well, most of us don't just go put it in a coffee can and bury it in the yard. Some people do that. And that is savings, and those savings don't flow to businesses, obviously. But most of us don't do that. But here we have like literally millions of households who save. How do their savings reach businesses, either in the form of debt or equity? And the answer is they do so through what we will be pleased to call financial markets. Well, what happens in financial markets? Well, what happens is financial intermediaries conduct buying and selling between households and other households and businesses, but ultimately the flow of savings from households to businesses is what's going on. So the financial intermediaries, and here are the names of some of them. A financial intermediary can be a person, or it can be an institution, or it can be a whole group of institutions. Here I've got listed on slide 2-3 whole categories. Mutual funds. If you don't know what a mutual fund is, you will after you read chapter 2. You surely will know what a mutual fund is. Pension funds. Everybody sort of thinks they know what a pension fund is, I suppose. Maybe not. Everybody surely knows what a bank is. And people do know what insurance companies are. A lot of people say, well, insurance companies, how are they financial intermediaries? Well, the answer is that you think you're just giving them some of your money. It's called a premium. So you say, well, I'd like to get my car insured. So I'm going to give you this premium, since you won't give me insurance if I don't. And so from your perspective, you've bought insurance, right? And you're not wrong, you have bought insurance, but from the insurance company's perspective, what did they do with the money you just gave them? They do, in fact, save it, but actually they do more than that. They are active participants in financial markets. They go out and buy financial instruments or other real assets that are, from their perspective, investments. And so they take those premium dollars that you pay them, you think you're just paying for your automobile insurance, and those dollars find their way into financial markets, where they in turn find their way into the hands of businesses who do what with them? Well, they don't go buy cheeseburgers with them, because that's consumption, isn't it? They don't go pay labor with them, because that's just paying labor. That's not putting plant and equipment in place. And in fact, they wouldn't have any way to pay back. If they're paying labor with the insurance premiums that you're paying for your car insurance, what happens when you have an accident? Where do they get anything to? There's nothing to pay the claim with, just as Jake says. And so they have to earn a return, as it were, to be able to pay claims and also to sustain their business operation. And that requires investment. So moving on to 2-4. You've got this basic idea then. So when corporations now, somebody might say, well, when they retain earnings for growth and reinvestment, what's happening then? And we talked a little bit about this the other day. They're really saving on behalf of the households who are their shareholders. They're just sidestepping the financial market now, aren't they?
And that was something that confused me when we first talked about the circular flow model.
Yes.
Where households are the only ones who save, but, you know, I thought, can't businesses save also? But, you know, that bullet point right there explains it.
They do. Businesses do retain earnings, and some people will say that's saving, isn't it? And the answer is yes, but it's in a flash also investment, because, and sometimes it's not, by the way. Corporations do, and we are told right now, are sitting on mountains of cash. They are not putting new plant and equipment in place, even as we sit here talking. And that's one of the reasons why our economy at the macro level remains sluggish and growth remains slow and unemployment remains high, is precisely because businesses who are retaining earnings are not investing those earnings in new plant and equipment, which then invites the question, why not? Which gets us much closer to the real reason why our economy continues to languish. And we're not here to talk about that right now, so we won't. If you like, you can read my blog. I've written copiously about it there. On slide 2-4, still mutual funds and pension funds, in addition to being important financial intermediaries in financial markets, they provide these benefits to households. They don't do it out of the love of their hearts. They do it because households are willing to pay them for these services. Professional money management, which is highly overrated, by the way. We'll learn more about that in investments, but that's a different course. Efficient diversification, which is an important feature of mutual funds and pension funds. The idea of diversification is a very simple one at base, the idea of not putting all of your eggs in one basket. So if you were going to hold financial instruments of one kind or another, say stocks or bonds, just to make life simple, you don't want to buy just IBM stock. Why not? Well, because anything could happen to IBM and has in the past, and the value of your savings and investment could go down precipitously. And so the idea of diversification is, well, you want to buy maybe as many as 20 or 30 different stocks. Well, that's quite expensive to do that. For people who've never dabbled in buying stock and all that, might not even know how to go about it. It takes time and it takes resources to do that. Well, mutual funds and pension funds. When we say pension funds, we're really talking about something that is really going by the boards these days. It used to be lots of companies had what we call defined benefit pension funds. And the way those operated was that the company would promise that if you work for us for this many years and you retire with us after you meet the minimum requirements of age and longevity of service, we will pay you for the rest of your life X dollars per month. And so from the employers and employees' perspective, this was kind of like deferred compensation. So instead of paying you money right now, you're working for us, and instead of paying all the money that you might get from us right now in a voluntary exchange market, we'll hold some of that back. And in return for that, we will operate a pension fund for you on your behalf. And when you retire and you're invested, as the term goes, in benefits, it's like an annuity. We'll pay you this many dollars a month for the rest of your life after you retire. Well, that's what a pension fund amounts to. And these days, most companies don't have them. There is one important remaining entity that just loves pension funds, and that would be governments. Government workers do still have pension funds. Indeed, I myself am a vested participant in the Virginia retirement system. I also, of course, have other retirement benefits that I'm trying to generate on my own. But when I retire from teaching someday from good old UVA Wise, why then the state of Virginia will pay me X dollars. I don't know what X is exactly. Depends on a formula for the rest of my life. So state governments and municipal governments, and yes, the federal government, do have defined benefit programs. We know Social Security, for example, is a defined benefit program. It's a sort of pension fund, except it doesn't operate actuarially. So that's what a pension fund. A mutual fund, as you'll read about in your read Chapter 2, is an investment company that you buy shares in. And what do they do with the money that you give them? Well, they turn around and they buy financial instruments, either stocks or bonds or both, and hold those financial instruments. So you're buying shares in an investment company, so the value of the shares in the investment company depend on the value of the financial instruments they purchase. Well, they can operate on a large scale and buy lots of different stocks and bonds, and indeed many mutual funds have a direct connection to a stockbroker who give them special rates and all that. And so they can buy a diversified portfolio of financial assets much more efficiently than you can. So the mutual funds are quite advantageous to households. There can be tax advantages from holding one's savings in a mutual fund as opposed to holding the individual shares of stock, and it can go the other way too. That's why I say maybe, maybe not. Depends on too many factors to discuss here. You know, if you're interested in that kind of thing, then you might consider being a CPA accountant. So, and then also mutual funds and pension funds do definitely lower the cost of valuable information to households. Think about all the time and trouble and toil it would take to pull together enough information to figure out which company's stocks you might want to buy. Well, they've got fund managers who do nothing but that day in, day out, 365, 24/7. Right? So they can generate that valuable information at much lower cost than you or I can individually. Financial intermediaries, it goes on to point out to us on 2-4. See how boring this stuff is, actually. Here I am sitting reading slides for you. They provide benefits to businesses, too. From the business's perspective, you've got all these households out there that have little money, but little pieces of money, but businesses want big pieces of money, right? So the financial intermediaries, like a bank, like a mutual fund, like any operator in financial markets, who take in small bits of money and pool it together into big bits of money that can either be borrowed or used to purchase equity. So you think about it. You go, here you are, you're a household, say, geez, I found this $100 that I don't want to consume. I want to save it. So you trot down to your local T. Rowe Price or whatever your favorite broker is and say, I want to buy a mutual fund shares in the XYZ mutual fund. And they say, sure enough, and they take your $100, right? What good is $100 to a business? You might find that in the carpool outside somewhere. It's not nearly enough. But if hundreds of thousands of people do that, and they give their money to a mutual fund, what does the mutual fund do? Well, they go buy shares of stock in the ABC Corporation, or they buy bonds in the XYZ Corporation in large denominations. Now you've pooled small bits of money into big money. These financial intermediaries, particularly the banks, facilitate the payment system. Used to be checks flew around, right? These days, not so much checks. These days, it's more debit cards and credit cards that people use. But if you'll notice on your credit card, it's affiliated with some bank, isn't it? So that's part of that payment system. Risk management, the notion that financial intermediaries can better understand risk and diversify against it and so forth than individuals can. And then, of course, generating the valuable information that households would find so expensive to do themselves. On slide 2-5, we have our first encounter, as it were, with this idea of the cost of capital. We're going to come at this from several different angles in this course before we're all done with it. Well, we do remember the idea of cost from foundations of economics, and if we didn't have the privilege of taking foundations of economics from some economics that we studied, perhaps, the idea of cost. Now, the most fundamental and meaningful notion of the word cost is value foregone. Value foregone from what? From some action, from some choice that someone made. That is the most basic notion of the idea of cost. In fact, it is the only meaningful idea of cost. We're prone to say in economics, if it's not an opportunity cost, it's not a cost at all. If it is not a value, if it's not a measure of some value foregone, then there's no cost involved. Couldn't be a cost. Okay, so that's the notion of the word cost. Now, what about capital? What's the notion of the word capital here? Is the word capital here money? Is it plant and equipment?
Look at the definition. It could be.
It's tricky, isn't it?
Yeah.
Here on slide 2-5, it says the cost of capital is the minimum acceptable rate of return from investment in real assets. Now, this raises so many questions in my mind as to be almost meaningless. Let's see if you can come upon some of those questions. Acceptable to whom is the first question that comes to my mind. And what do you mean by investment in real assets? Well, if you say investment in real assets, we must be talking about a business. Because when we're talking about investment from the household side of things, that's really saving. And those savings get translated into a financial instrument which then shows up as funds available to a business to, quote, invest in real assets. So what I've got written here on 2-5, which is just standard stock and trade stuff, and you see it in the textbook, it's not particularly helpful, is it? Well, let's see if we can interpret this a little bit and get some meaning out of it. Jake, I'd like to borrow $100. Will you lend me $100? Jake gives me an immediate and proper answer, maybe. And I said, okay, well, under what what's the maybe about? Under what conditions will you do that? I do want to borrow $100.
Are you going to pay me back?
Am I going to pay you back? And I said, yes, and you know me, you know where I live, and you know I'm an upstanding guy and all that. So after a while, Jake scratches his head and says, okay, well, yeah, I trust Professor Kendall. He's a trustworthy guy. So can I borrow $100?
Are you going to pay any interest?
Oh, so now pay some interest. What do you mean, interest?
Well, you have to pay me back a little bit more money than you.
Oh, why?
That's the rental price of using my money.
Well, why do you want a rental price?
Well, because there's a cost.
Oh, cost.
There's an opportunity cost for me.
Oh, there's value foregone if you don't have your $100?
Right.
Ah. Now you begin to see that there is a cost of my using Jake's money. So there's a very meaningful sense in which we can just interpret the word capital there as money, can't we? And say, well, I want to use your money. It's not my money. You've got some money. I don't have any. I would like to use your money. I'll borrow it. And Jake just entertained the possibility that he might be willing to lend me $100 that he happens to have lying around. But there is some minimum acceptable rate of return before you'd be willing to do that. What is it, Jake? 0.5% per year?
A little more.
He says going to augur for a little more.
Depends on how long you want it for.
Oh, he thinks that maybe if I keep it for a longer time, he might want more rate of return. And indeed, this is precisely the way people think about it. If you want my $100 for one day, I might just let you use it for one day and just say, give me back my money tomorrow. I don't even really care about it.
Drive a pretty hard bargain.
Yeah, I mean, you know, for 100, well, you know, you say that, he says it drives a pretty hard bargain, but on the other hand, if you happen to be a bank and you happen to need to borrow $500 million overnight, it turns out that there's a very active market for that very thing. It's called the Fed funds market, and it turns out that the minimum rate of acceptable rate of return is held within very tight bounds by the Federal Reserve System, and these days is 25 basis points.
It's a quarter of 1%.
It's a quarter of 1%, and for one day it ain't nothing, right? That's a quarter of a percent per year. So for one day, you can divide that by about 365 and you get a pretty small number. But when you're multiplying that pretty small number times 500 million, you're no longer talking about chump change, right? So even overnight, but just between Jake and me, he'd probably lend me $100 overnight since he believes that I'll give it back to him the next day. But if I wanted to keep it for 10 years, now what?
We need a little more interest.
Why, though?
Well, because that's a lot can happen in 10 years.
A lot could happen. I could die, for example, right? And you might never get your money back. And if you just lend to me and I die, you're just SOL. But if you lend to a lot of people and some of them die and some of them live, then you can make up on what the ones that live against the ones that die, and so get a return. But so now we've given a little meat to this, and we put it on an individual basis. If I'm going to borrow your money, there might be some minimum acceptable rate of interest that you would be willing to entertain. Okay, well, when we broaden that to the notion of not just individuals, but all households who are saving something, and then businesses who are hungry for access to that, shall I say it, capital, so that they can purchase some, shall I say it again, real capital, right? You begin to see that there might be a market involved and that a market rate of return might emerge through the interactions of voluntary exchange of would-be borrowers and would-be savers to establish what could be called the cost of capital. Well, in what sense it is a cost? Precisely in the sense that an economist means cost. Value foregone. If you're going to lend me your $100, you're not going to have it. You're not going to have it available to buy cheeseburgers, and worse yet, you're not going to have it available to lend to Harry, who would agree to pay you 25 basis points more than I would. There's always that possibility, right? So there is a cost. Okay, now that's one way to look at it. Then we say on slide 2-5 of the next bullet, the cost of capital can be thought of just as the rental price of money. Firms won't get the capital, that is to say money, if they cannot be expected to generate and pay that rental price. So if I'm a growing business, a corporation or a big corporation, or if I'm a small business, a mom and pop shop, and I need some money, maybe if I'm a mom and pop shop, maybe I cook cheeseburgers and sell them to people, I might need to buy a new French fryer. Well, where am I going to get money to buy a new French fryer?
You've either got to take it from
my pocket, my own pocket, in which case I am also, even as a business, a saver. I'm a household too when I'm a business. I could just buy it out of my own pocket, in which case I had to save it, not consume other goods and services with it. Or if I didn't have any that I saved personally, I could go to the bank and borrow it if they would lend it to me. Or I could take on a partner. Say, well, I'll tell you what, I'll take you in as a partner if you'll buy a new French fryer for the business. Well, then you'll be a 5% partner in the business, right? So you begin to see how all this works on a small scale. It works the very same way on a big scale. It just involves more people and more pinstripe suits, right? That kind of thing. So still, it must be the case that a firm, a business, a corporation, or a small business, they won't get the money if they can't imagine themselves, and people who are going to give them money imagine it possible that they get paid back. Plus, not just paid back, well, they want their property back. It's their money. They can give it to you. They want it back. They want to charge you a fee for renting it. You're renting their money. So that's another way to think about the cost of capital. Well, we go on to say on slide 2-5 that we frequently express the cost of capital. The word cost should get us thinking about a sum of money or value foregone. But generally in finance we express it as a percentage rather than a dollar amount. We do that to make it independent of the size of the investment. One of the most helpful ways for me to think about interest rates or rates of return, which may be the same thing or may be slightly different depending on the nature of the investment. An interest rate is the per dollar rental price. So you want to borrow $1, how many cents on the dollar do you have to be willing to pay me to rent my dollar? If you say 5 cents on the dollar, then I go, oh, that's a 5% rate of interest, isn't it? So that's a very helpful way for beginning students to think about the cost of capital when it is expressed as a percentage rate. Okay, so we conclude here on slide 2-5 on this notion of the cost of capital with the bullet here. This is like all costs, the cost of capital is an opportunity cost. If it isn't an opportunity cost, it ain't no cost at all. You get households to let them use saved money. Any single firm must offer the rate of return available from other firms that also would like to use that saver's money. So it's a price too, isn't it? It's like a price. Interest rates are a kind of price, and they represent, from a particular perspective, a cost. We're beginning to get the idea. Cost, and what does it depend on? Well, like all other prices, interest rates depend on the supply of loanable funds, the supply and demand of whatever we're talking about. Here we're talking about loanable funds, aren't we? So the cost of capital is going to depend on the demand side of the loanable funds market and the supply side. Well, what are those demands and supplies going to be related to and depend on? Here we've given some ideas about it. How risky is it? Remember, if I want to borrow $100 from Jake, he might agree to lend me $100. He might even agree to lend me $100 for a whole year. How about we lend $100 to Sam for a whole year? What's the first question that comes to mind?
Who's Sam?
Who the hell is Sam? Right? Sam who? See, you've got to have some notion of how risky is this? Is Sam like a fly-by-night guy? Does he have a tendency to gamble? What is this thing? Is Sam? Right? Who's he? How safe is the investment? Like T-bills. T-bills, believe it or not, are still safe, not regarding all of the brouhaha surrounding government debt these days, and that's simply because the federal government, through the auspices of the Federal Reserve, can print all the money it wants for a while. Low risk, safe investments tend to have a lower cost of capital. Risky, unsafe investments, and I put in there, that is to say, most companies. You'd be surprised how risky most companies really are. They have a higher cost of capital. People tend to imagine that corporations, just by virtue of being corporations, are safe, reliable investments. If only it was.
Because of their size.
If only it were so. Enron was huge.
People get the impression that just because the corporation is large, that it must be safe.
Yeah, and it's not. It's not necessarily so. We've had many instances of that in the past to look to. Companies can and do default on their debt. That doesn't necessarily mean they never pay the bondholders. It means that they miss a coupon payment. Well, a missed coupon payment, that is to say, you were due interest for 6 months of them having used money that's yours, and they don't pay you. That's default. Now, 2 years later, they might pay you, but still, they didn't do what they were supposed to do, and the cost to you was higher than it was supposed to be. Yes. All right, so we finally arrived at the end. So what have we learned? Well, we've learned, we hope, talked about at least, it remains to be seen whether we've learned it, but we have at least given a word or two, how financial markets and financial institutions who operate in those markets. So we didn't really have a lot of words to say about what's a financial institution, but there's going to be a lot of words in Chapter 2 about who is. You know, Aetna is a financial institution, Bank of America is a financial institution, T. Rowe Price is an operator in financial markets, they're a financial intermediary. Now the list goes on and on and on. Any kind of investment company is a financial intermediary. Any kind of bank is both a financial institution and a financial intermediary. So what are financial intermediaries? Well, they're just another way of saying what a person or a whole group of people do as a financial institution in financial markets. What are they all engaged in, even though they don't necessarily see themselves this way either? If you go up and ask a guy that sells life insurance for Nationwide, are you a financial intermediary? What do you suppose he'll say? He'll probably say, no, actually, I'm in the insurance business. Actually, he might actually know. He might admit that he is. He might have been well trained. On the other hand, he might just be hardly trained at all and a good salesman, right? And so he might say, no, actually, all I do is sell insurance. But they are, and what are they engaged in? They're channeling savings of households to business investment. That's a very important concept. Now think about this for a minute. Think about around the world all of the countries that you can think about who are dirt poor. And there are plenty of them. It's not hard to think of several. What kind of financial markets do they have? The answer is nearly non-existent. Do you suppose that's just coincidence?
You have to have savings to have financial.
You do. And it's a reciprocal effect as well. If you don't have financial markets to channel whatever savings there are to businesses, how robust do you think an economy is likely to be? No. So it's a chicken and egg thing. It goes hand in hand, in other words, with each other. The savings of households and the well-functioning, efficient financial markets are sort of a necessary condition for good economy.
Right. Well, a business investment is what creates a good economy. So
yeah.
If there's no savings, no financial
business activity creates produced goods and services, and we all recognize as good young economists that producing goods and services typically is the outcome of combining capital and labor, right? It's not just the product of labor, it's the product of labor and capital. One way to think about capital is that capital is the embodiment typically in plant and machine of previous labor, isn't it? It's another way to look about produced goods like shovels and trucks and the like. For what purpose? No, not to consume directly, but to ship cheeseburgers around the country and that kind of thing. This capital and labor are the basis of producing goods and services, and of course the production of goods and services is the source of what we're pleased to call wealth. If you look around the world, find me a poor country, I'll show you at the very same instant a country that doesn't produce much. They go hand in hand, don't they? So the basic structure, it says on slide 2-6 of mutual funds is something we learned about. We didn't talk too much about it. You get to read a bit more about it in the text, which is only appropriate in pension funds and banks and insurance companies. And the truth is, we have other courses where we spend a bit more time on the nature of financial markets and in particular institutions in them. We have a course at this college called Money, Banking, and Financial Institutions, where we would spend a bit of time talking about one or another of these institutions. We have another course called Investments, Analysis, and the investment analysis, we talk about any number of these particular financial instruments, particular kinds of bonds and stocks and so forth. So this is really just a broad brush overview that we've got in Chapter 2, but it's a good place to start. And then we talked about the key functions of financial markets, which of course we know now to be the connecting of savings of households to would-be borrowers of those funds, businesses, and how they operate. These institutions channel those savings in financial markets. So that's really the nature of what you learn in Chapter 2, just the names and who the players are and the structure a little bit. And we did end up talking about this really important idea that will recur over and over again, a bit more in this course, and then if you take financial management down the road, a lot more in that course, because in financial management we actually get into the business of calculating, well, what is the cost of capital here to this particular firm, and it's going to turn out to be the case that what the cost of capital is going to determine whether or not they invest in a particular project or not. And we'll get a little bit of that in this course as well. So the very basic idea of how the cost of capital is determined in financial markets. Well, how is it determined in markets?
Through voluntary exchange.
Voluntary exchange of would-be borrowers and would-be sellers who are connecting with each other in that nebulous market that we call financial markets. Financial markets these days aren't necessarily even a place, are they? They used to be heavily associated with places like Wall Street. There's a financial market, right? The big board. Now there's a financial market. Well, that's not wrong, but it's also not the whole of it. These days we're getting much closer to what people call global financial markets. And why? Because, well, yeah, I can go this afternoon online and purchase a share of stock of some Taiwanese company if I want to. I can go online and within minutes purchase the bond of a, God help me if I did this, a Somalian company.
They even have companies there.
Yeah, I think Jay said they even have companies there. Well, they think they do. Probably somebody must think they're in business in Somalia, but probably be hard to find a bond from Somalia company. It'd probably be hard to find. But through those voluntary offers to buy and sell stocks and bonds and other kinds of financial instruments which are priced all the time, daily. In the case of stocks, we could turn on our computer here. I could go to my stock trade account, my Scottrade account, which I happen to have, and we could turn on the trading platform, which is available to me right now in Scottrade, and we could watch the movement of any particular stock we'd like to watch, and we could watch it in a candlestick diagram and see the sales happening in real time and seeing the price go up and down of a particular company literally by the second. And if there's high volume in that stock, well, it's just constantly moving, might be moving up, might be moving down, might be a lot of volatility, might be hardly any, and all of that due to people voluntarily making offers to buy or sell a share of several shares of this company's stock. You don't get quite that much activity in bond markets. Bonds tend to be traded in large blocks. They don't tend to be traded quite as frequently as stocks do, but still they are traded, and there are daily prices of bonds, and usually they're traded through brokers and so forth, and prices are a little harder to discover and so forth, but that's what's really going on. So that's it. That's all I've got to say, and several of you out there are saying, thank God he finally shut up. We're done with everything I've got to say about chapters 1 and 2.